In finance, people often say smart money belongs to the institutional giants, the private equity and the venture capital firms that dominate the headlines. But over the last decade, I've watched the lines between institutional funds and private wealth blur and get redrawn. Hi, I'm Jean-Baptiste Wautier. In my 30 years in private equity, as well as serving on global boards such as Pershing Square and Howard Hughes, I can confidently say family offices are no longer content being passive spectators in someone else's fund. They're stepping directly into the finance arena. Today, I want to talk about how family offices are competing head to head with the giants, reimagining the finance space. Traditional private equity has a glaring Achilles heel that family office investing doesn't have to deal with. Standard institutional theory is built on a countdown. A fund buys a company and immediately starts looking for the exit. I've sat many times in those boardrooms where a company is performing well, but it has to be sold, not because it's the right time for the business, but because the fund clock is ticking. The solution, this is where family offices have changed the game. They don't have a ticking clock on their capital. They can hold a great company for 10, 20, 30, or even 50 years. I call this professional stamina. While a PE firm is often forced to flip an asset to meet a deadline, a family office can prioritize long-term health over quarterly optics. They aren't looking for a quick exit, they're looking for a legacy. For a founder or for a CEO, that difference in the why behind the capital changes everything about how they lead and how they choose to partner with financially. I can think of many founders, including some of the ones I currently back, who choose a partner looking for a legacy over a partner looking for a quick flip, simply because they don't want to be boxed into an artificial timeline that is entirely disconnected from how the business develops, how markets evolve, and last but not least, also disconnected from the way they look at their own evolution. And you don't need several $billion for high performing family office investing. But there's one thing you do, which is discipline. What are the four disciplines of the family office arena? Number one, conviction over volume. Most successful family offices avoid the spray and pray model of venture capital. They wait for the specific moment where they have a clear edge, a clear conviction, rather than trying to hit a quota of deals just to stay busy. Discipline number two, respect the friction. In direct investing, long-term security comes from understanding the operational grind of the companies you own. If you aren't prepared to understand the friction of the day-to-day business, you shouldn't be leading investments in it. Number three, liquidity means opportunity. I've seen this happen time and time again. When the market freezes up, institutional capital often stays on the sidelines. But the one with dry capital and a long horizon is the one who sets the tone during a crisis. In a world of rising debt, liquidity is the ultimate offensive weapon. And number four, build for legacy, not for the exit. The modern job market and the global economy behave like a flowing river. It's not static. If your entire strategy is based on a quick flip, you're vulnerable to the timing of the market. But if you build for the next generation, you control the clock. Typical large market cycles like the internet bubble, the GFC, the COVID crisis, or even the current Gulf crisis are instances where family offices can thrive, while the institutional giants can be forced to pull back. Overall, capital is becoming a commodity, but patience is also a premium. The most successful investors of the next decade will be the ones who can afford to wait. So the real question isn't just about the how of the investment, it's about the who. Are you partnered with someone watching the clock or someone watching the horizon? I'd be curious to hear from you. If you were a founder, would you take the fast capital of a VC or the patient capital of a family office? If you found this macro perspective valuable, stay tuned for more conversations like this. Thanks for watching and see you next time.